Good day, everybody, and thanks for joining us today for our fixed income quarterly webinar. Today, this will be a review of 2023 and a view of what to expect from 2024. My name is Murray Anderson. I look after the retail business at Prescient. Joining me on the panel today is Bastian, our Chief Investment Officer, Reza, who looks after our bonds, and Henk, who looks after the cash and income space. Bastian, first up with you. I know last week we spoke about this, but we need to review the global macro environment, certainly for 2023, and then take a look at what's coming at us in 2024. Can you give us some insight, maybe a reflection first on what took place last year?
Sure, Murray, thanks, and thanks everybody for joining. What took place last year was a year with a lot of volatility, I guess quite mixed asset class returns all the way up until October, and then after October we basically saw a steep rally after the Fed pivoting, so to say, hinting towards lower interest rates in 2024. We actually saw strong asset class returns. So what must we focus on this year? I guess again global growth, the implications of global growth on global inflation, and with that the path of interest rates, which the Fed will dictate. And all of this during a period where asset classes mostly globally are expensive, where we have a lot of elevated geopolitical risk. But luckily here in South Africa, we are starting from a point where we've got high interest rates at the front end of the curve. So our income provider strategy is still yielding 10.5 or 10.6%, and our bond funds earning more than 12%. So a good starting point this year around.
Great. So they say macro matters. You've got interest rates, inflation, geopolitics, etc., but probably the one on everybody's mind is global growth. So where do we go from here with the global growth story?
No, that's exactly right. So global growth is probably the first most important driver which we have to look at. Luckily, we see a quite good environment for global growth, despite all the risks which we mentioned. But at the same point in time, we also do see downside risks to our view, and we must acknowledge that the US economy mostly looks quite split in a way that we have a very strong consumer sentiment, which is luckily 67% of the US economy. But we have a quite weak business sector and a quite poor manufacturing sector as well. And with this kind of like diverging sectors within the EU economy, heightened attention is appropriate, I guess. So when looking at the US economy, we always like to start by looking at the Prescient Economic Indicator. It's our own in-house nowcasting tool, telling us where the US economy is in real time. We've done this so often with you before, but just to reiterate, it is a statistical model from Stock & Watson, basically a multi-factor model which analyzes a lot of factors which drive the economy in real time. We've just got a little bit of a summary on that page. Here you can see that we're looking at all kinds of factors, for example, like domestic investment, sentiment, gross domestic production, financial conditions, but also labor market conditions, economic conditions, personal consumption, expenditure, etc. And then obviously behind that there are way more data series to look into. I'm just extending on sentiment in this instance, but I can do the same for the labor market conditions or any other indicator, just to give an understanding on what we're looking at. So we're tracking the common trend in all of these indicators, and with that we understand what the US economy is doing in real time. So is all of this working? This regression line here tells us it is, because what you can see on the x-axis is the Prescient Economic Indicator, and on the y-axis real GDP, and you can see that there's a quite strong correlation between the two, meaning that using data in real time to estimate where the US economy is does actually work. Easier for us to understand is to look at this line chart, which you can see in this picture. So you can see in the dark blue line the actual GDP prints which we've seen in the past, then in the light greenish area the forecast which we have put out there through our models. And as you can see, the two follow each other quite closely, with the Prescient Economic Indicator being slightly leading. So if I now zoom into the more recent past to get an understanding where we are in real time, you can see this small yellow dot on the right hand side telling us that the US economy is growing actually with above 2.5, more towards 3% in real terms now, which is quite extraordinary. So from our point of view, the whole discussion around hard landing, soft landing is potentially a little bit premature. We do think that nothing hints towards a recession being around the corner. We said the same last year. It actually worked out quite nicely last year with no recession hitting us, but we do think this year could be more of the same. I mentioned that the economy is quite split in a way that we have a very strong producing sector, very weak production sector, manufacturing sector, very weak business sector, but very strong consumer confidence. So this chart basically sums that up nicely. On the zero line here, you can see all the elements on the right hand of the zero line basically are positive contributors. On the left hand side, we've got detractors from US growth, and you can see that economic conditions generally are detracting quite strongly, and then basically stuff like the labor market being also a detractor now, which might come as a surprise because some people see the labor market as strong, but it is really weakening quickly. But then on the right hand side, you can see most importantly the personal consumption expenditure, so the consumer, and then also consumer sentiment being very, very strong drivers. We had a very strong print of the Michigan consumer sentiment and Michigan consumer expectations a week ago on Friday. And that was one of the factors which really pushed our indicator into even more positive territory.
Thanks for it, Bastian. So you showed a lot of indicators there, but sort of the two-speed economies, you've got industrial production slowing, yet you've got this consumer sentiment strong and consumption rates are still high. So a strong labor market would be inflationary, leading to high interest rates, which could be persistent for longer. Do we agree to that?
Yeah, we actually don't agree to that. So you are right, I agree with your argument. Strong labor market would obviously eventually lead to stronger GDP growth, more demand side driven, more stronger demand side could lead eventually to high inflation and then through high interest rates, but we don't really see that coming. So if we look into the labor market, we can actually see a lot of softening. So with that, a scenario where inflation comes back up and interest rates stay higher for longer is actually amongst the scenarios which we put out there, the least likely one. Okay, so why are we so convinced that the labor market in itself right now is not inflationary anymore? For that, we have to look a little bit more detailed into the labor market itself. So we start off by showing this labor market heat map. All it does is it shows on the y-axis different labor market metrics, and then in the different colors we basically paint in dark red a negative normalized score and in dark blue a positive normalized score. So whenever you can see a lot of red, the labor market is particularly weak. You could see that through the great financial crisis, you could see that through COVID. Whenever we are in the dark blue, the labor market is particularly strong. Showing it this way just gives you the ability to visualize a lot of different data sets in one go, so to say. So you can see, if you look cautiously and zoom in on the right hand side, that we have obviously been in the dark blue. That is what has enabled the consumer to be very strong. Very, very strong labor market. But if you look cautiously, especially at some of the data series at the bottom of the page, you can see that that is changing. So we have moved from the light blue into the whitish, partly even into the light red. Same here for non-farm payrolls, where we're back to whitish, so i.e. quite normal levels. Same applies to non-farm employment in total. And then you can also see forward-looking labor market metrics like quits, so how many people are voluntarily leaving their job for a better opportunity, or hires, how many people are employed, new people are employed by companies. And you can see that all of these are moving from dark blue to light blue, white, potentially even red, as we can see on the hiring rates. So let me just show you that a little bit more detailed. I'm focusing in on the employment. So just switching off the employment to population ratio and the labor force participation rate to focus on prime age participation. So those are all the employees which are of an age of 25 up to 54. We're doing that to eliminate structural biases, and by doing that you can see that the participation rate has really started to ease. I need to zoom in a little bit more to see that clearer, but you can see that we are coming off the peaks here clearly. We can move into job creation. Most often quoted non-farm payrolls. Going to switch off some of the alternative reports and just focus on the actual prints and potentially the 12 months moving average. You can see that we're clearly in a downward trend here. So the pressure on the labor market is easing. There's many metrics which show this. I'm just doing one more. Let's look at the hiring rate, so the rate at which companies in the States are hiring new people. You can see once again that it's really coming off its peak. So all of this doesn't look too inflationary. So the proof is in the pudding, so to say. So we can look at the actual wage growth rate, which is the last chart we're going to show. And what you can see here is that we are really coming down from the peak 6.7 all the way down to 4.3 and a steady trend downwards. So long story short, the strong labor market is not that strong anymore, and with that it's also way less inflationary. Something we spoke about extensively already last year, and that's my last point, is also a look into productivity. So if you bring productivity back into the picture and see, as an example, looking into unit labor costs, so you can then see quite clearly that even with elevated wage pressures, the elevated level of productivity, or the improved level of productivity which the US economy is displaying, enables the economy to operate with a tighter labor market way better, so with way less inflation. So there's lots of reasons here from our point of view why inflation is not going to be the problem of 2024.
Okay, Bastian, from that reading, it would show us that, the Fed's engineering a softer labor market. Inflation is not too much of a worry, yet we've had this higher interest rate environment. US growth is okay, but what does this mean now for the next shift in interest rates?
Yeah, so we like to put forward two core scenarios. The one is our base case, backed by the present economic indicator, no recession, backed by our analysis of inflation, no inflation worries, so kind of like the perfect soft landing. It's an optimistic outcome, which is not a given, but that would be our base case. And the alternative scenario would be that we have the US economy eventually roll over, that the strong consumer in itself is not strong enough, the labor market maybe rolls over quicker than expected, and with that we see actually a recession in the second half of 2024. Both scenarios though point to low interest rates. So with that our base case and our alternative case would both point to low interest rates later this year, obviously in a different path, the one being faster, the other one being slower, but both scenarios pointing to low interest rates. So we can obviously be wrong with that, so I'm not saying there's no opportunity for higher rates, but the scenario normally which is cited for higher interest rates for longer is inflation coming back, inflation resurging, inflation being more sticky, and with that eventually a path of higher interest rates for longer. And it is always a possibility, especially with all the geopolitical risks, but we don't think that's any of the core scenarios which we should consider. So with that, definitely lower interest rates later this year. The pace is the question, but obviously the argument we're making is for a very positive outlook for our bond market and also for our income market with a little bit of duration which we're carrying in the funds as well.
Bastian, we said macro matters, but equally geopolitics seems to matter even more this year. We've got some significant issues on the horizon, two of them being some fundamental wars that are taking place, in Eastern Europe and elsewhere in the Middle East. And then we've got all the elections coming up. We've got something like 60 elections around the world taking place this year. So the global population is heightened around who's going to be the next president of whichever country you want to pick. But maybe just talk to the geopolitics that we have to face this year as well.
Good point, obviously. I mean, it seems to be the talking point. Everybody's speaking about geopolitics these days for good reason. All the elections, you mentioned them already. And then we have two wars close to Europe, which is obviously quite worrying. So I don't want to downplay it. I do want to say, though, that in our systematic approach, we look at geopolitical risks a little bit differently. So we look more at the numbers or the data which we can measure. So as an example, we are not too stressed about President Trump being re-elected, more about what does it mean for the consumer, what does it mean for business confidence, what would it mean for potentially profit margins of corporations, which could benefit from tax cuts. Potentially it's a good thing. So when we speak geopolitical risks, we often all know exactly what's going on, but the reality is even if you know what's going on, it's very hard to understand the reaction function of markets. So with that, we don't really focus too much on predicting where those goes and really look at the data. I will say though, it is right, this is particularly a period of elevated geopolitical risk. We do think the biggest risk is going to materialize at the later stage of this year, which is only in November when the US election is held. And the reason being is that obviously the outcome of that election, despite all the risks which it carries in itself, also will impact the other major risks like the war in Ukraine or the war in the Middle East. So long story short, yes, a lot of geopolitical risks out there, but potentially very hard to focus on them too much because it doesn't really help you to make smart investment decisions.
Okay, Reza, Reza's head of our bonds team. Given the macro backdrop that Bastian has depicted for us, let's have a look at 2023 and certainly what to expect in 2024 from the bond markets. I mean, yield curves are hugely important, driven by a lot of these factors. Let's have a recap of 2023 and then share with us some of your views on 2024.
Awesome. Thanks very much, Murray, and welcome to all our viewers at home. Always a pleasure to share some insights and thoughts with you. Yeah, so coming to the question of yield curves, all right, so it's obviously massively important to the fixed income space in general. But just from a pure sort of first principles definitional perspective, I mean, what is a yield curve really, right? So at a very basic level, it's just a plot of bond prices at different maturities, generally plotted as a set of increasing maturities, and the different prices generally quoted as yield. So that would be a very surface level definition of the yield curve, but we know generally that from economic literature that they generally don't stop at that point. It's not just a plot of prices, right? It's many would actually say that the yield curve is a set of initial conditions or initial starting points for the business cycle in its entirety, right? So if we just try to bring that home into something that is a little bit more tangible, we can think of, for example, the front end of the yield curve as having a direct anchor point or bearing to consumption. And how does that really work? Many of us would obviously be familiar with either financing a home or a vehicle, and you know that the applicable financing rate or borrowing rate would be linked to something like the prime lending rate. And that, of course, takes its cue from JIBAR, and JIBAR, of course, takes its cue from the nominal repo rate, which is set by the monetary authorities, right? So you can see that how the impulse for consumption is ultimately dictated to at the front end of the curve by the stance of monetary policy. Looking further out in the yield curve now, we can also see that, for example, if we look at, Bastian was talking about wage growth, right? If we look at the wage setting process, right? So the wage setting process is typically multi-year in nature, and that would look farther out on the yield curve in the sense of what are the embedded inflation expectations that one can glean from the yield curve a little bit further out. And then that in turn would feed back into the real economy via the wage setting process. So you can see, far from being just a plot of prices, it naturally affects the impulse for consumers to buy things, and it also affects a range of things from growth expectations to inflation expectations. Bringing that a little bit closer also to home in terms of asset prices in the space that sort of we play in, the starting point of the yield curve has been critically important in the past 2 years, especially if you look at places like the US, where we focused a lot of our attention being a big engine room for aggregate demand. A lot of talk has been as to what is really this very elevated front end of the US yield curve. What has that really meant for attitudes and appetites for risk? And very importantly, what has that meant for capital flows into traditionally high carry emerging market destinations like South Africa? So I'd like to perhaps show this and illustrate this via some charts. So the chart that we see in front of us is arguably the most important chart for asset prices in totality, and it's a simple plot of the upper bound of the effective federal funds rate through time. So this goes back to basically before 1980, so that is pre-Volcker, all the way unto the present time. And what we've done over here is that we've actually highlighted the different hiking and cutting cycles, and we've colored them differently. So for example, in this turquoise color, let's just say, or teal color, we can see the various hiking cycles. And if we just hover over that and we focus for a minute, you'd see that the rate that we are at now, that is 5.5%, that is the upper bound of the effective federal funds rate as it stands today after the latest FOMC action. And what we can see is that if we just look at approximately the slope of this line relative to all the other sort of turquoise colored line, in other words, in all the other episodes in which the federal funds found themselves in a hiking cycle, we actually find that this is actually the steepest hiking cycle on record. In fact, if we're talking about the era post-Volcker, right? So that is after the 1980s, let's just say. So it's been the steepest hiking cycle for a very long time. But really the issue that I really want to draw into focus is actually what does this starting value of 5.5% mean in terms of capital flows, right? So I was speaking a little bit earlier on as to how the starting or the front end of the yield curve finds a voice in a range of economic real activity processes. But what does this really mean? This also means that 5.5% also serves for the moment as the global risk-free rate, right? So all depository rates in the US and all sort of credit instruments or money market proxy instruments in the US would generally take their cue from a 5.5% effective risk-free rate in the US, right? So that is quite competitive, and I will show just momentarily what this actually has meant for capital flows. In other words, this has created, and the general point that I hope to draw out is that this very, very, very high risk-free interest rate of 5.5% in USD terms at the front end of the curve has proven to be, if we go by the data, an extremely high hurdle to overcome for global capital to look anywhere else, right? So let's just have a look at how this plays out in one other chart. So here we have a chart that shows South African cumulative bond sales to foreigners, right? And so what we can see is that this chart finds its way all the way back to the early 2000s. And what we've highlighted either in a pinkish color or the sky blue color are various recession episodes. So for example, this very broad one refers to the GFC, that's the global financial crisis, which took place at around 2007 to 2009. Early 2000s, we have the dot-com crisis. Then we've got the taper tantrum, which took place at around 2013. And then most proximately, we've got sort of the COVID episode, which occurred around 2020 to around 2021. So these are cumulative bond sales to foreigners, and what we can really see is a story that would go as follows. So immediately in the aftermath of the global financial crisis, what did we see in the global sort of policy landscape? We found that many developed world economies cut policy rates to zero, and this gave rise to what was popularly called the carry trade, right? So it meant that you could effectively borrow money for next to nothing in developed world economies in sort of hard currency locations, and deploy that money in sort of high carry emerging market destinations, the likes of South Africa, Brazil, Russia, Poland, Indonesia, and the like, right? So you saw that, and we can see that the cumulative bond sales actually start increasing immediately after the global financial crisis, right? That is to the tune of around sales to foreigners of around 250 billion, right? That was cumulative, sort of like in the early 2010s, right? That goes on around a steady pace, and the cumulative sales to foreigners increase rather healthy, in a rather healthy fashion, until you get to the point of the COVID crisis, right? So you'd remember that in the wake of the COVID crisis, we also had another sort of event risk episode, which was we got our final downgrade to take us into sub-investment grade territory. And we can see there in terms of cumulative sales post the COVID episode that has really taken a swan dive downwards, right? If we hover over this, we will see that that point is around the 4th of April, 2022, which is more or less just a month after the hiking cycle in the US had commenced. That was the 15th of March, 2022. So what we can see that from this point, there hasn't really been a recovery in terms of cumulative sales to foreigners since the COVID episode, right? It's basically just been wave after wave of sales by foreigners. Now, this is a twofold episode, or rather a multifold reason behind that. Part of which is that, number one, South Africa lost its investment grade status, but very, very importantly, if we look at the kind of attrition that we've seen since early 2022, this is largely because the front end of the US curve is offering such compelling risk-free rates that makes the carry trade a very, very hard sell to actually get over the line. So we can see that in terms of cumulative sales to foreigners, but what we can also see in terms of overall foreign holdings, if I were to just plot this graph, this actually moves immediately after the wake of the global financial crisis. Foreigners owned approximately 40% of our bond market, and we can actually see that reaching a peak in around 2018, where foreigners owned around 43% of the South African bond market. That dwindles all the way down towards the COVID era, and now we're sitting sort of at a measly 27%, right? So that is quite a step change from what we've seen. And like I say, it's this nexus of reasons, partially being that we've lost investment grade status, but actually much more proximately and importantly for the context that we now find ourselves, is that the front end of the US curve, this is largely coincident with a lot of cumulative sales and a lot of the foreign ownership actually dwindling to actually very, very low levels.
Okay, thanks, Reza. That was a great description of what's taken place in the US. So you've had short-term rates increase, you've had this inverted yield curve, and obviously in South Africa, we react accordingly. Often you've said we take direction from the rest of the world, particularly the US 10-year. How's that played out in South Africa? And what do you expect given the slope of the 2-year versus the 10-year in South Africa? And what can we expect going forward?
Sure, that's a great multifaceted question. I'll try to do justice to it. So I mean, I think my colleagues will probably agree with this characterization that I often use this phrase, perhaps a little bit too often. But there's a little bit of a tug of war going on, right? So South Africa, I mean, most commentators and sort of financial market participants will agree that we've got very high real yields, right? So you've got real yields, whether in fact, whether you look at that in real terms or in nominal terms, yields are high, right? So what's the bad part? The bad part is that we're actually still coming against a global environment where financial conditions are still quite tight, right? So financial conditions, just broadly speaking, is a set of variables that actually got its name, shortly after the financial crisis, and what does it really mean? People have defined it variously, but it's really just a broadly accepted set of variables that basically dictate what future growth is going to look like. So at the moment, you've basically got an inverted yield curve. That's sort of one ingredient to the global financial conditions landscape. You've still got a strong dollar. And if we talk about monetary policy in real terms, in reference to, let's call it a natural or R-star kind of rate of interest, we still got monetary policy that is now quite restrictive, right? So that cocktail actually means that financial conditions are at the moment now still quite tight, although the path or the trajectory, the forward-looking trajectory of that is that it does in fact ease. Bastian was talking about, even if we look at both of our scenarios, almost like a high road and a low road, both of them culminate in sort of interest rate cuts at some point, right? So the curve will become, the least one we can say, it will become less inverted, right? We know that the dollar often loses its kind of attraction as soon as sort of the cutting cycle starts to start. And also monetary policy, since we're talking about that in real terms, that will also become sort of less restrictive. So you have that weighing in the background, but you also have got very, very compelling real yields that affect the South African landscape. And I'd like to show you that in the form of a mosaic in just a moment. So being a systematic, quantitative, data-driven house, we like to really frame the sort of the asset or the investment decision as to what really matters for the asset price process. And in the case of bonds, we really try to answer that very, very simple question with reference to what you see in front of you and what we like to call this factor mosaic, right? So we filtered around 300 variables and we've tested all of them for their sort of predictive efficacy or their ability to basically have some role in telling us where bond prices are going to be over the next year. So as I described a little bit earlier on, what we can see is that the blue color generally relates to valuation-centric metrics. In other words, we can see that South African real yields are quite compelling, hence the blue color. Relative yields relative to places like the US is also something that is quite compelling, and the SA term premium, in other words, the additional compensation that one would get by investing in a long-term bond in a lock-up fashion in excess of rolling over short-term yields, that is also a metric that is quite compelling in the South African bond space, right? Pulling in the other direction, as I spoke to in some length, is basically financial conditions, right? So financial conditions for the moment now, they have not turned as yet. The US, certainly between the 2-year and 10-year, still finds itself with an inverted yield curve. The USD still carries a considerable amount of strength, and we know that certainly in terms of emerging market locations, a strong dollar is never good news. It broadly acts like a tax on consumption because it affects input prices. An argument can be made that exports become a little bit more competitive, but that process inevitably happens with a lag. And monetary policy, we know, for example, if we look at places like the US, the real policy rate now with disinflation gaining some traction is in excess of, let's call it the R-star or a natural rate of interest. So financial conditions quite tight. South African yield characteristics quite high, or valuation related characteristics quite high. Where does that put one in aggregate, right? So if we added all these things together in a fruit salad of sorts, we'd basically get to a dial which suggests that taking all these factors into consideration, we basically land up with a moderately positive stance, right? So it's moderately positive. If we can understand neutral as broadly indicative of having an all-be-like bond stance, i.e. no active duration, then moderately positive would mean that you have some active duration, but not an extreme amount thereof, and strongly positive at around 3 o'clock here would mean that you should really try to maximize your active duration budget. So taking the cocktail of risks and opportunities and the attractiveness of valuations and all factors that have proven to offer some efficacy, throwing all that into the mix gets us into a moderately positive stance. Now, some might ask, Reza, you were approximately moderately positive for large parts of last year. If we look at this line chart, which shows exactly the score through time, some may argue that you were moderately positive for last year as well, and the Mosaic didn't look terribly different to the latter parts of last year as to what it looks now. How then were we able to witness the kind of very strong bond rally and risk asset rally in general in November and December of last year, given that there hasn't really been a change to your Mosaic? And how do we answer that question? Well, the simple answer would be that what has happened, you actually had that risk rally in November and December on account of certain pronouncements by key developed market banks. If we just look at the Federal Reserve as a pointing case, they basically mentioned that you could, if we take, for example, their dot plots as anything to go by, you could expect something to up to about 3 cuts during the course of 2024. So what actually happened is that markets actually preempted, right? They got a little bit ahead of, and they looked a little bit forward as to how exactly these things would actually change. In other words, for example, if we look at the 2-year, 10-year slope, they still find themselves in a negative territory. In other words, the 2-year yield is actually higher than the 10-year yield. But markets actually found themselves in November looking a little bit past that and looking through that and saying there will come a time, if FOMC pronouncements or anything to go by, that this yield curve will in fact disinvert, i.e. it will start to resemble a normal upward sloping yield curve. The same thing with the USD and the same thing with monetary policy. Markets in effect sort of leapfrogged and looked ahead as to how these factors would in fact evolve over the course of 2024. We actually don't do that, because what we actually do is we rather allow the data to speak for themselves rather than trading on basically speculation and sentiment driven flows. We actually rather wait until the factors themselves actually change complexion. In other words, we'd rather wait until financial conditions themselves would become disinverted rather than trading on sort of an assumption that this is actually what's going to be that actually plays out, right? Doing this actually makes sure that we have a strong backbone to the kind of flows that we're going to expect. If these were to turn blue, it actually means that you have a solid sort of growth-enabled, growth-centric kind of financial conditions, general context, and we'd rather prefer to sort of calibrate our bond stance based on these financial conditions metrics actually changing. What we then do, and this is perhaps a little bit of a longer video, but basically what we then do, and for the sake of basically brevity, we then move from getting a score, which has been generated by this Mosaic, and then what we can do is that we can basically generate a set of expected returns for the entire term structure. In other words, we can have a set of expected returns for each bond on the entire term structure, from 3-year floating rate notes, from treasury bills, all the way up to the longest bond as it stands now, the 2053. It has basically got an expected return based on how we know these parts of the yield curve are likely to perform under different state regimes that we have. So we've got, for example, as we saw a little bit earlier on, moderately positive, strongly positive, neutral, moderately negative. We've got all of these states of the model, and we are able then to basically ascertain, knowing our knowledge of what's happened in the past, expected returns for every bond on the term structure. This puts us in a very, very powerful position to be able to construct portfolios based on these set of expected returns for starting instruments.
Okay, Reza, thanks for a very detailed explanation. I mean, you consider all aspects of the market, the curve, you look at the various factors. Now you've got to go and construct a portfolio for clients. Run us through the portfolio construction process, And maybe, if you don't mind, just talk about the risk characteristics and how you protect portfolios from a risk management perspective.
Thanks very much, Maria. So I think that in terms of what we've described in terms of internalizing the sort of the macro environment, how we assimilate that information and how we ultimately produce a score is something quite powerful. But ostensibly there might be others in the industry that might actually differ with us. Like, for example, I showed that our stance at present is one of being moderately positive, so having some active duration. But there may very well be other players in the market that actually say, we actually disagree with you here. We actually think that you should be a lot more bearish, or actually you should be significantly more bullish, right? So there might very well be other players in the market that basically differ with us with regards to the overall stance, right? And that's absolutely fine. But one thing that we are very particularly proud of is how we in fact take that score, taking a stance as given, right? And actually constructing a portfolio from that point, right? As I say, people might differ with us as to how you get a score, but once you've got a score, how does that actually find its way into a portfolio? So what I'd like to show you now is actually how we go on the journey from actually feeding into an optimizer a set of expected returns. We think that expected returns is somewhat sort of a value add in terms of the house that we have, in the sense that they are conditional on having a particular score. We feed that into an optimizer, and we basically overlay that with a risk management sort of paradigm or framework that takes into account not only the expected returns, but what you can also expect in terms of downside surprises or downside deviation. And we think that combining the two, a set of conditional expected returns together with downside deviation considerations, makes for a very, very powerful sort of portfolio construction story. So I'd like to show you that now. This is our bond portfolio construction sort of landing page, and I'd like to walk our viewers really as to how this works, right? So you'd remember a little bit earlier on, we explained how we move from a score, that is in turn informed by a mosaic of factors. So that score would give rise to a set of expected returns for every bond on the term structure, and that basically gets fed into an optimizer. So what we have here, optimizer sounds like quite a complicated word, but what it really just means is that we're just looking for an ideal way to blend bonds together in a portfolio such that you get the best expected return, but also that you don't want to basically overexert your risk budget, where our risk budget here is basically defined as downside deviation. So what you can see is a plot of sorts, and this plot basically considers all different combinations of bonds that are possible, taking as inputs the expected returns that I just spoke of. What happens is, to the right of the graph are really combinations which you really don't want to explore, because these are the ones that have a low expected return and also downside kind of characteristics that you really want to avoid, i.e. downside deviations, certain combinations of bonds that are really going to surprise on the downside, i.e. give you a nasty negative return relative to the all-B, and that's a kind of a return we want to avoid. On the left side of the graph, we have those that are actually stacking up quite well in terms of expected return, and sort of this outer frontier, very much sort of akin to the Markowitz frontier, if anyone remembers that from elementary finance. But basically what we want to get is the frontier of portfolios that score the best in terms of expected return, but also don't have too much punitive or too punitive downside characteristics. And what this optimizer simply does is it allows us to actually to look through that. So we put that through that, and effectively the end product thereof is we select the 10 best portfolios that have got the best risk-adjusted return, i.e. the 10 best portfolios that score best in terms of jointly having a good expected return and not too punitive downside deviation characteristics. And what it actually gets summarized by is this rather intimidating looking line, but we'll go through it together so that I can just explain. So we have that the portfolios are ranked on a risk-adjusted return, but that in turn is a function of the expected alpha or the expected returns, and I showed you in the previous video how those are derived, minus a lambda times downside deviation. In other words, this looks quite intimidating, but all this really tries to say is that there are certain times in which I actually have more conviction in the score of the model, and certain times in which I actually have a little bit less conviction. Generally speaking, when the model is at one of its two extremes, that is extremely strongly positive or strongly negative, we want to actually minimize this lambda term, because that's the actual time at which you will have the highest conviction in your model. When the conditions are such that you are actually strongly positive, actually it's more like a 3 o'clock if you remember the dial, we want to actually minimize this lambda term. So that's all that this is doing. It's tying together the notions of expected return, that's what we had on the first page, the notions of downside deviation, that's where risk management comes in, and this notion of a lambda term, which simply speaks to the level of overall conviction that we have in the model. So it's got 3 ingredients, but we believe that these are really 3 prudent ingredients, and they lead to basically a risk-adjusted return measure on which we basically rank the portfolio. So you can see here the portfolios ranked numbers 1 to 10 have all got a particular target combination of bonds. They've each got some expected return characteristics. They've each got characteristics which speak to their modified duration, their convexity, their value at risk, and their risk-adjusted return. And we take the 10 best and we average that, all those 10 portfolios, and this gives us a target allocation, right? So this shaded in the green is effectively showing you that taking all things into consideration, your target portfolio as of the data available today should look as follows, where we've got a fairly healthy allocation to the R2037, that's about 52% of the portfolio. We've got something in the R2040s, that's about 6%, 16% in the R209, and so on and so forth. Everything documented in the target column as shown on the extreme left. Alongside that, or juxtaposed to that, we find the actual current allocations, and what you can see in the final column is the amounts that we've got to trade in so sort of bringing the current portfolio in line with the target portfolio. So this is really the process that we run every day, and as I say, it will take a set of input assumptions into account, from the overall score of the model to the expected returns of each bond on the term structure, and it will really construct a portfolio that takes all these things into account in sort of a prudent, risk-managed way. I think that basically creates a portfolio for you that is able to sort of robustly serve the best kind of trading conditions, and also takes into account sort of our assessment of the macroeconomic environment to create a robust portfolio solution.
Reza, thank you for that explanation. So let's wrap it up. We've got a portfolio of bonds that you've constructed, risk metrics in place, optimized. What can we expect from a return for the year ahead?
Okay, so that's also another great question, and I suppose maybe viewers would tune in for just this question. But basically, so sort of the running yield at the moment of the fund is around 12%. I mean, so that alone is something that is quite attractive. But what we prefer not to think sort of in terms of only running yield terms. We prefer rather to express our forward-looking expectations into an expected return for the portfolio. So that number sits at around 14%, and I'll explain to you very, very briefly how we unpack that. So if we think of sort of the running yield, that is essentially just almost like a coupon cash flow yield, right? So you know that a bond has got predefined coupons. It's going to happen every 6 months, right? So you're going to get a return in lieu of that, right? What we also know is that a 10-year bond today will become a 9-year bond next year, right? So as the bond moves down the yield curve, it basically moves to a different and typically shorter cohort, and there will be a different general yield that will be associated with that area of the yield curve. So that's what's referred to as the roll down yield. So there's a little bit of return, or a little bit of juice that you can squeeze down from the roll down component. And then, for example, we also have things like, typically our bonds at the longer end are trading at a discount. That discount needs to unwind at some point, and 88 needs to become 100 at some point. So we also have another component of return that is in lieu of a pull to par effect. And finally, and this is perhaps sort of the area where ourselves and many other houses might differ, but there's also a return that basically speaks to almost the capital gain component of the bond, i.e. what return is going to accrue to this bond on in relation to yields either selling off or compressing, right? So taking all those things into account, and since we are in moderately positive, I mean, our base assumption is that there is going to be a degree of yield compression. So taking the yield compression, the roll down effect, the pull to par effect, and the coupon cash flow yield takes us to an all-in expected return forward looking of around 14%, right? So which is basically, if we think that even if we say that inflation gets to the very upper end of the SARB band, so let's just say it's 6%, it won't be 6%, but let's just even say 6%. So if inflation's at 6% and you're earning sort of 14% on an expected return basis, taking our cumulative knowledge about how the bond market's going to evolve, then you're sitting with a tidy 8% real, which is nothing to be scoffed at.
Absolutely. Thank you, Reza. Appreciate it. Henk, turning to you, bit more of a shorter end of the curve view, SA income space. Again, we had rates rising through the latter part of last year, which would have affected, for those that are in the savings environment, positively with interest rates rising. But obviously there was a lot to deal with during the year. Can you share with us how you managed your portfolios, and then give us a view, given this macro environment and potentially a rate cutting environment going forward, how will you structure the portfolios in the cash and income space going forward for 24?
Excellent. Thanks, Murray, and thanks everyone for dialing and tuning in. Bastian for our macro overview. Reza, a little bit closer to home, but still sort of a macro. But if I think about what's been shared and where we've been, and I think a lot of the talk is around uncertainty, a lot of geopolitical noise. It's sort of the perfect storm for us as Prescient Investment Management in terms of the way we think about markets, our systematic approach, really trying to cut through that noise and get to an outcome that's backed by the data, by the empirical evidence that we see. So if we take what Basti has said as being the playing field this year, sort of the global macro, we take one of the tools that we have at our disposal, the bonds that Reza showed us, the income space really this year looks good again. Certainly yields in excess of 10% that we expect, a lot of different drivers of real return, and you don't have to take a lot of risk this year with yields being as elevated to get to those sort of numbers. Okay, so last year, yes, very good here, but certainly looking forward this year again, looks very attractive for the front end of the SA yield curve.
Sure.
But what does the yield curve look like at the moment? What's the expectation for cuts in South Africa? And maybe we can look at some of the US charts as well. So if I can start with the SA yield curve. Okay, so the chart we're looking at here is one you are familiar with, which we share often, but really this is the market expectation for interest rates in South Africa over the next sort of 2 years, so the forecast period of the Monetary Policy Committee. And what we can see very evidently is we are expecting some sort of normalization or some cuts in the near future. So if we think where JIBAR is currently, so this is the rate we're trying to predict, as 8.4, we can see it sort of ends around the 7.3 level at the outer years of the forecast period. So a little bit more than 1% of interest rate cuts that's expected in the South African context, which is interesting if you think about what the US is pricing. So a lot has been said about the soft landing, our views, inflation being sort of a little less sticky than what sort of at least last year we saw, and this year expectations. But this is where the Fed is currently, so just under the sort of 5% or 5.5% upper level, with the expectation of coming down to around 3.5%. So almost 2% of interest rate cuts priced into the US. So I think the long and the short of it is that yes, interest rates are priced to come down in South Africa, but maybe not as much as needed and as one would hope for. If we then look a little bit closer, or a little bit further out that yield curve into what we would call the belly of the front end, and really on the 3-year area of the curve. So if you allow me to get there. There we can see, and very interestingly though, an inverted yield curve, right? So if we think about the compensation for risk, or how much is priced into that part of the yield curve, we can look at what we call the 3-year swap rate. That's the one highlighted in the turquoise or teal color. That's the 3-month JIBAR rate, the one we looked at just now. And really what this is telling us, what's the average of 3 months going to be for the next 3 years. And what we can also then look at is the difference, so how much compensation for risk. And you can see throughout the hiking cycle has been said, probably the steepest in history, a lot of compensation, but certainly now, if I look at where it is now, sort of 70 basis points lower, you're not getting paid for taking on risk in that area of the yield curve. So what we've seen, yes, the front end is still elevated, the belly of the front end is starting to price for these cuts, not a lot of value for us there. What we then can do, and focusing on what Reza shared with us, and showing the expected returns along our bond curve. We can also bring in the back end of the yield curve, run our own optimization, give it some risk metrics. So I've got a term to maturity of 100 years. The income space, luckily, we have a lot of flexibility in the tools we can use. I've got about 1.6 of duration. That's with more or less the current sort of stance. Each instrument can also be about 100 years. Don't let that scare you. It just gives us the flexibility. I will optimize for total return, and it will give us expected or the best expected portfolio given the different tools we have to play with this year. And you can see a solution yield of about 10.6, more or less in line with the current portfolio yield. But more importantly, what is it picking? What is it telling us? How should we position our portfolio for the year going ahead? So you can see it wants about 75% floating rate in this 3-year area, which makes sense if we think about the compensation I showed you, 3-year being lower than 3 months. And then when it takes on some duration, it wants to pick sort of the belly of the bond curve, very much in line with what Reza has shown us. So 2035 bond, about 23% of the portfolio. If I then take all of this and look at what the current positioning looks like and talk to some of the changes we saw throughout the sort of last quarter of last year, certainly the one key change has been a little bit of an increase in duration for the portfolio as we saw a bit of risk budget opening up. But certainly the way we've taken on that duration is where the key changes, and we've moved from sort of a little bit more of the 6 to 7 year area, a little bit further out in line with where Reza has positioned the bond fund. So what we can see here from a positioning perspective, certainly fund AUM grown nicely to about 38.4 billion, a running yield of 10.75, so very, very attractive still. That's a JIBOR spread of about 2%. And a duration of about 1.52, so that's the fixed income or the interest rate duration as we stand. And as I said, the key change here being switch from the 2030, which is the 6-year area, to closer to the 10-year 2032s. And certainly if we add some more risk here, we start to look at the 2035 bonds as the optimization has shown us. So about 25% in fixed rate, so take on some of that exposure. Certainly if you think about the total return expectations, still a lot of value for us there. And then just a different mix of floating combinations or assets that we can buy or tools we can use, from normal corporate sort of floating rate bonds, mainly bank exposure, some structured ideas around credit linked notes, some building blocks that includes our renewable energy, some infrastructure debt, as well as our credit fund, the Prescient Income Plus fund, a little bit of offshore, so 10.3% offshore, a little bit of money market in that sort of 1-year area where we see still some value in fixed rates, and a small component of pref. So nice diversified mix of assets, very strong running yield, get close to our return targets, very much in line with our risk target.
Henk, thanks for that description. Importantly, in the income space, people are concerned about 2 main points. One is the income that you spoke about, particularly those in post-retirement income portfolios, looking for the income on a monthly basis. But the other critical element is capital preservation. Can you just talk about how we go about considering capital preservation in the income provider portfolio?
Yeah, excellent question, and I think that's one of the key sort of areas that sets us apart in the income space, certainly from the way we view our income funds. So if we think back to when we started the income provider fund or portfolio, late 99, early 2000, was for a beneficiary trust client of ours, consistent of widows and orphans. They needed a solution where their little bit of money they had would grow with inflation. But more importantly, to answer the question, was that risk management, that they couldn't afford to lose money. So we said we'll construct a portfolio, we'll target CPI plus 3, that's the target return of the income provider portfolio. But most importantly, we'll structure the portfolio to never lose money over any 3-month period. Okay, and then that is our risk target. So what we've done subsequently throughout the years is we've developed our risk budget, our risk management tool, and we've made it sort of visual for clients to see, to show them how we consider it all when it comes to risk in an income fund. So the income universe is obviously very wide. There's a lot of diverse sort of drivers of return, different funds doing different things, be it duration, be it offshore, be it credit, different structures you can do. But for us, it's very important when we're adding risk to a portfolio or a tool, is to understand what does that mean from a risk perspective. And let me show you how detailed we can get when it comes to risk management. Okay, so looking at the dashboard in front of us, really is our risk budget. And if we think about that rolling 3-month positive return, or not losing money over 3 months, that's our risk target. that gives us a certain amount of budget we can spend. So that could either be what are we going to earn for the next 3 months, so that's what we call the 3 months of yield. But in reality, we could also breach our target in the next month, in the next 2 months as well. So we have to consider what happened a month ago plus what happened 2 months ago. So that's just the sort of table of risk budgets we have. What we do then is we take the most punitive one, currently 2.7% or 2.69, which is our running yield in the portfolio. So that's the budget component, and that's the easy part. Okay, the more difficult part and where the real sort of nuances and tricks comes in is how much risk are we spending currently? And that really comes down to the value at risk numbers that we show you on the right here. So to get to those numbers, to understand the current risk in the portfolio, we break down the portfolio on an instrument level. Okay, that's this table over here. So we can consider every position we have. What is it? So it's a 2030 bond, which is a government bond. So it's a fixed rate government bond. But what we also know is it's got a risk proxy or a risk identity. And that's a 6-year government bond or a 10-year, or there's some offshore there. There's some cash as well. So for each instrument, we can break it down into its risk proxy. So what is the risk that it introduces to a portfolio? We can aggregate the portfolio according to risk proxies. But that's what we do here. And if we have that and we have our risk proxies and we have the data on a rolling 3-month period for each proxy, we can run the current portfolio through time and see what does it look like from a risk perspective. So that's what we look at in this blue mountain, and a lot of you have seen this before, and it really is our intention for you to get very comfortable and used to this, because this is really the backbone of how we think about things. So what is evident here? Obviously a well put together portfolio, a lot of sort of the distribution being to the right of the zero line, but the most important thing here is what happens to the left here. So what is the worst outcome or worst case scenario for us given the current portfolio, and how does that sort of relate or at least speak to the amount of risk we can take? And what we can see here from a budget perspective and the current risk perspective, focusing on 99.5, we are very much in line. Not fully maxed out, but certainly room to add a little bit, but very much in line with our risk target. So again, considering it all, understanding all the risk that's inherent in an income fund, and making sure we always adhere to and keep that sort of risk target of ours intact. And that really gives us the ability to compound positive real returns through time and generate a market-beating return for our clients.
Henk, thanks for that description. Despite a pretty tough environment last year, the fund did really well. We've spoken about the macroeconomics and the geopolitics that expected to play out this year. What expected changes, if any, do you foresee for the portfolio, the income provider for the following year?
Yeah, good question again. And really, as I said, the playing field is quite wide. We do see there's still some opportunity, but it's a very good time for income fund that has a lot of risk focused in its process. So there's uncertainty, but there's opportunity. So to navigate that, those waters, certainly income is a good place to be. But just looking at last year and to sort of give a sense of how diverse the drivers of return can be, let's break down the sort of return contributions of last year. Okay, so looking at the different drivers of return for last year, you can see from the different bar charts here broken down into the different sort of segments. And if we just zoom into sort of last year and focus on, oops, that's a mouse error, apologies for that. There we go. You can see a very strong quarter. I mean, this is the quarterly webinar, really strong end to the year, but really a nice diverse drivers of return for us throughout last year. Definitely from a fixed rate bond perspective, adding quite a lot of value, that being our number one driver of return. But from a floating rate bond, so on the floating rate side of things, nice, a steady contributor. Again, also on the CLN side, so just the structured credit we do, and all the different drivers really adding. The only one detracting throughout the year was really the preference shares, but a really small detract if you look at sort of this. Then the sort of second part of the question really is, if we look at the contributors here, what are we expecting for next year, or at least for this year, and where will return come from? As Reza's very nicely shown us, there's still a lot of expected return on the duration side, certainly on the bond side, but another key driver for us, certainly on the income side, is on the credit side. And certainly on the credit side, we are still a little bit we could say cautious, and I'll show you just an idea of some of the spreads that there's been a lot of compression, but Conway and the credit team, and certainly on the income plus side of things, are still finding attractive assets in line with our view, and certainly that's another area of the sort of portfolio we can expect to certainly add value. And then finally, the last component would be offshore. But first, just to give you a sense here about sort of the compression on the credit side and how important it is to understand the risk in credit and how we think about them when it comes to portfolio construction. You can see over the last quarter, these are the sort of compression versus the sort of spreads moving wider. The asymmetry there is quite obvious. But looking a little bit more so sectorial, you can see banks, sort of subordinated banks, on this chart, very much a story of compression, sort of credit becoming more expensive, and your focus on where to be on the credit spectrum becoming all the more important. That, again, is where we do a lot of sort of work around, and certainly take a lot of cue from our credit team. Yeah, then so we've got the duration component where we see some value. We've got the credit where we need to be surgical when it comes to understanding the risk. It's obviously some compression, but still some value there for us. And then finally, the offshore component. I think there's a lot of interesting opportunities there. We're doing a lot of work on revamping our offshore process, and certainly very excited about the opportunity set in that space with markets changing. Another key driver for us, I think, this year on the real return side.
Thanks, Henk. Folks, we've come to the end of our presentation today on the fixed income and bond side. Just maybe in summary, I think great opportunities from a fixed income space, across the opportunity set from money market to income plus to flexible bond. And that's on a real basis, while interest rates are still high, there's really good opportunity. So, thank you to the panelists for sharing the insights. I know some very detailed descriptions that have been provided. We love sharing this stuff with you. As you've noted, very systematically driven quantitative orientation around building portfolios, very strong on the risk management side, and we really do entertain everybody to come and engage with us on our processes and delve into the tools that we can share how portfolios are built. So to close, thanks very much. But before we leave you, obviously there's time for questions. If you wouldn't mind posting your questions in the chat, and we'd like to address those. But thanks for being with us today. Thanks, everybody. We've come to question time, but we're very conscious that we've taken a long time to go through the presentations. Hopefully detailed enough, certainly from the observations on the screens using our portal. We've shown a lot of detail. So we've got one or two questions, and I think just in terms of making sure we don't take too much of your time, we won't dig in, and those questions that we don't get answered, we'll come back to those folk directly. But Henk, just ending off with you, we're talking about 10.7 running yield, which is a really great return out of a portfolio, strong risk management characteristics. There was a question around the credit side and the credit risk management, which I think kindly you addressed as that question came through. But if there's more detail on the credit risk management side, we'll pick that up separately. So thanks for doing that anyway. But I think certainly credit risk in fixed income portfolios is key. But again, the 10.7 running yield is a fantastic return from a portfolio that has very little downside because of the risk management characteristics that we put in place. But if I can turn to you, Reza, there was a question around flex bond and the returns from 2023. I mean, we're expecting about 14% from the year ahead. Maybe just last question, or for your first and only question to end off, is today just talk about those characteristics and how they're sort of driven out of the 2023 calendar year, but just reaffirm them for views for 24.
Sure. Thanks very much. Yeah. So maybe somewhat, maybe just let's start somewhat retrospectively and look at the performance drivers for the calendar year 2023. So what we know is that we typically ran a portfolio that had a higher duration than that of the benchmark of the Orbi, and that was approximately about 1.5 to 2 years more than what the Orbi had in terms of active duration, right? So what we do know is that the yield curve sold off by about 100 basis points or 1% over the year. And so we lost out essentially on the duration call. I mean, there was around about 2% there. We then gained a little bit on the initial yield side. In other words, your running yield of the fund. We ran a portfolio that typically had a higher running yield than that of the Orbi, and so we gained 1% over there. So you add the two up, we came up short about 1.5% last year. So it's a combination of a higher running yield, but then obviously the level of the yield curve obviously selling off quite precipitously, and we're losing out there on almost the capital gain component. That's really what it was.
Thanks, folks. Yeah, we're going to call it there. I mean, again, it's taken well over an hour, but we thank you for your time. We thank you for the questions. We have one or two that I will certainly come back to the people that post them. Thanks very much for doing so. Thanks to the team, great insights, and we look forward to engaging you in the not too distant future. And please look out for the following. We've got a couple of more webinars coming up, so please do attend those as well. Thanks again for your time today.
Thanks, everyone.
Thank you very much.